I think the key takeaways for the office market in Italy is that is an asset class very resilient, deeply demonstrated by the tenant demand, which is very high. As other asset classes, it shows very strong fundamentals. So Italy, it's not a distressed market, but it's a market driven by a huge imbalance between demand and supply. There are a lot of supplying constraints in Milan for the administrative process timing, in Rome because the conversion of a CBD office building is probably more suitable for an hotel than for an office now. So the possibility to create and generate new pipeline of grade A building in the city center of, let's say, the main markets in Italy, which are Milan and Rome, are very limited. The demand of a tenant is very high, and this is driving a big increase in the current ERV in the market. It's pretty impossible to find good quality space in the city center now, as it's not easy to find product to be adapted to the new concept of office, doing a value-add strategy. To me, the big constraints we have so far is the liquidity in exit, because it's very differentiated in terms of location. Buying asset in the CBD historical center give the possibility to create a very liquid product, because the equity is there and is mainly represented by family office, in general private capital coming, and domestic capital mainly. There are no more Italian pension fund willing to buy, or let's say are less than in what we experienced in the past. We are still struggling a bit with the traditional core equity, meaning the German one, the French insurance company that were buying the large scheme of office in the past, that are now a little bit still resilient in coming back in the market, also because the spread, considering the prime yield, current prime yield, and the level of a 10-year bond there is a spread only of 50 bips, while in the past, from 2015 to 2021, was more than 200 basis points. So now core equity is still struggling to come into the market, and who is doing the value-add part of the strategy is struggling a bit with the liquidity in exit, if the product is not super located in a highly central location. It's semi-central, it's a grade B, and where really there is no market, or just private market, but very opportunistic buying double-digit, and a huge lack of financing, I would add, in general.